You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Good morning, and welcome to Day 2 of the Reimagined Options Industry Conference, our first virtual event. I hope you enjoyed our program yesterday. Henry Schwartz kicked off the day with his always popular State of the Industry slides, accompanied by a spirited discussion. We were also treated to the insights of some Washington experts on the latest in our nation's capital, and a great panel discussion moderated by J.J. Kinahan on the growth of retail participation in options. John Davidson led a candid conversation with SEC Commissioner Allison Lee, and we closed the day with moving tributes to Joseph Sullivan and the 2020 Sullivan Award winner, Joe Levin. Yesterday's sessions are now available on demand under the Agenda tab, and today's program promises to be just as engaging and thought-provoking. As a reminder, although we're meeting virtually, our Pathable platform offers you multiple ways to connect with your fellow attendees. Navigate to the People tab on the top of the webpage to view an interactive list of attendees and speakers. To schedule a private video chat with another attendee, simply click the Schedule Meeting button on their attendee page, or navigate to the Conversations tab on the top of the webpage and click Private Meetings. These chats could be scheduled before, during, or after conference hours. Now, I know many of you have checked out the Sponsors tab to view and interact with our sponsors. They play an important role this week, and we truly couldn't bring this conference to you without their generous participation. Thank you to all of our industry partners for your support. And kudos to everyone who's taken advantage of the audience response functionality that we have here on the Pathable platform. And if you haven't used it yet, the chat and poll tabs are located to the right of the live video that you're currently watching. The chat tab is where you can connect with fellow attendees. And if you wish to submit questions for the speakers, use the polls tab. These will get asked as time permits during each session. We're also presenting our popular industry updates via on-demand video this year as well. Navigate to the Industry Updates tab on the top of the page to view video updates from OCC, the U.S. options exchanges, as well as SIFMA and STA. And of course, if at any time you need support or have questions during the conference, please reach out to us. If you hover over your name in the top right corner, you can then click the Get Support link to reach technical support. You can also visit the FAQ tab on the homepage for more detailed help. Another way to reach conference staff is to use the Talk Now feature. Click into the Talk Now session at the beginning of each day in the Agenda tab and select the Options Industry Conference booth. The blue Talk Now button will connect you immediately with conference staff. And now, let's get started with our first session, Current Issues in Market Structure. It's my pleasure to introduce the Chief Operating Officer of OCC, Scott Warren, as the session moderator. Scott?
Thank you very much, and thank you everyone for joining us. I'm going to be joined today by Alicia Crichton, Managing Director of Goldman Sachs, Paul Giaconti, Managing Director, Head of Business Development and Market Structure Strategy, and Kevin Kennedy, Senior Vice President and Head of Product Development for North American Markets for NASDAQ. With a very significant clearing firm, liquidity provider, and exchange representative, represented on the panel today. I think that we have the right group and cross-section of market participants to have a very engaged and delightful conversation about the current issues in market structure. So thank you, everyone, for joining us today. To overstate the obvious and the elephant in the living room, we often talk about unprecedented times, and that term may have been used way too much this year. But if you had read the headline, due to a global pandemic, 90% of the people working in the financial services industry in the U.S. would work from home for a year, what do you assume would have been the impact on the listed options markets in the options industry? How'd we fare? What made it work? And what should we start thinking about differently? So, Alicia, if you want to start.
Sure. I think, if you had asked us a year and a half ago what we would have expected, I think it would have been in many ways the opposite of, I think, what we experienced. Across so many asset classes, we experienced, I think, what can be described as our biggest and largest days from any metric, whether it was exchange volume traded, funds moving through the system, products cleared, all while we were transitioning to an almost fully work from home environment on an almost overnight basis. So I think, the anticipation of that versus what we lived were very different. I think the system functioned extremely well, the way we were able to move risk around the system, how resilient the system was across from both market participants through brokers, through clearing firms, exchanges, CCPs. I think it was quite extraordinary what the industry was able to accomplish, again, on an almost overnight basis. I think, the kind of primary driver of that is how prepared we have all been. If you think of a series of events, drills, coordination from an industry perspective, whether it's regulator driven or other kind of, industry trades driven, I think the industry was extremely well prepared and well coordinated. I think in terms, Scott, for your last question, the one place that I think we should think more about or, think differently about next time is the impact of floor closures. And what does that mean, particularly as we're trying to move risk through the system? I think that was definitely a kind of unanticipated consequence of needing to move to kind of a fully work from home environment. So that, I think, is probably worth some additional follow-up and consideration of what that means when floors are closed. But I'll pause there.
No, and thank you. And Paul, what's the perspective from liquidity providers?
Well, first, I have to say, Alicia, that was really well said. The one thing that I have to hope that never happens is we do it again. I look at it from two ways. One, I really want to thank those 10% of the people that went back into the office and kept us alive. Without them, I don't think that we would have done particularly well. I just think that you do need humans at some point along the way to make sure that computers don't cycle off. As far as our industry, I think it was extraordinary that we were able to turn it around so quick. And I always point out to my friends in academia that were at universities that were shocked at the end of March when they were closing down their classrooms. And when I got my computer set up on February 7th or 10th, it's 2 weeks into, we don't know what's really going to be happening here, sent to my house, as did every one of our traders. And I think that we weren't unique in that response. That, to take a line from a great movie is greed is good. We all wanted to get out there and make sure that our businesses made it, and we didn't wait for someone to tell us what was going to happen next. It was we, as an industry, took it on ourselves to, do the job that we have done for years. And when we're dumped with so many unknowns that were unknowable, certainly unprecedented, and I agree with Alicia, way overused term, but we, if it was ever appropriate, it would be today. And the markets had more information coming in to to translate into bids and asks all day, every day, and did the appropriate thing. Markets were wide; they were relatively thin at times, but with going on what we had going on, I think I'm shocked and thrilled, and looking forward to going back into an office though.
And Kevin, from the exchange operator perspective, what did you see?
So thanks, Scott. And Alicia and Paul, they gave great answers, and I agree with it. So there's a bit of an opportunity and I guess a restriction from going third. But I just want to pause for 1 second because they answered your question right away, and I know we talked about it in the green room. We just want to say, because this is the first panel I think for today, OIC is doing an exceptional job, and I think those panels yesterday were terrific. So a lot to build off of there, and I know I'm echoing the sentiments of all four of us, but now I'll answer your question because it gave me time to think about the question, so I better have a better answer. When I think about specifically asking your question, what my expectation would have been, I would have expected 252 days that looked like the day after Thanksgiving, and it was not pleasant to look at. But we, and I know our clients made really tough decisions with the floors and things like that, and our peers and our competitors. But what happened to me is exactly the same thing that happened with Netflix, Amazon, Zoom, Peloton. Those companies literally had a coming out party, and party's probably not the right word, but a coming out experience, because we got to show off all the hard work, all the good market structure that this community does together and has been doing, well for 30, 40 years. But honestly, since the crisis of 2007-9, market structure and options, because of the collective community and the service that was mentioned so many times yesterday, has done such good work. It finally paid off. And that's why you saw the increase. And that's why we're continuing to see the increase in options volume. So I was surprised at the volume numbers, no question about it. I can't revise history and say I expected this. What I'm not surprised at is the execution from Goldman and IMC, to mention the two that are on my panel, but honestly, all of our clients, incredible resiliency. And as a result of the hard work of this entire community, everyone listening today has been a part of that.
No, and I think it's phenomenal. And Alicia touched on it, is I think everyone's ability to deal with uncertainty. And part of that was the preparation. But as we went through March, I think there was a great deal of trepidation in the industry of what if there's an unplanned closure on expiration, right? And so working with the clearing firms, the liquidity providers, and the exchanges to increase the transparency of what are we going to do under unlikely circumstances, I think is a real tribute to the way the industry can work together to address problems. Because the one thing I learned this year is I can never tell my business continuity folks of why are we talking about that? That can never happen. Just a wild example, first time market-wide circuit breakers got elected, one of our clearing firms had moved to their backup processing center and had an earthquake in that location. That's not a series of events any of us train for and have a playbook. But as an industry, I think we all worked really well together to look down the road of what can happen next. How do we provide transparency and information to market participants? So I think it was a great job. And I think, the industry should take a great deal of comfort in the level of preparation of the infrastructure providers and the participants in terms of their business continuity and planning. But as we turn a little bit more to some more recent events, with GameStop, the GameStop hearings, we've talked a lot about implications for market structure. How do we think about the differentiation in options market structure from equity market structure? Paul, what's your perspective as a liquidity provider?
So as a liquidity provider and having a combination that does some peer and forward flow, routing, we have a pretty front row seat to this. As we have seen during GameStop, that people like to lump all, it's very easy to think that equities and options are the same thing. We certainly aren't. What happens is when a router gets an order, they get a routing instructions from their market maker. Market maker generally doesn't know which way the order's going, and they will say, put it into an auction at this price, at this place. It goes into that one, goes on to the exchange, and then is broken up a good portion of the time by competitors. So whatever price that you think it's going to trade at, or you thought that your liquidity was meaningful, it may not be good enough. And as a market maker for that mechanism, we're thrilled when it gets a better price. We get better statistics, do a better job for the end user client, and end up with a better allocation from that clearing firm or from the order flow provider. So all those things add to a really different experience than equities. And I'm not saying equities do it wrong. They have to, they're in competition with other firms at kind of a different level, but trade by trade, options are exposed to the entire marketplace. It's just a different market structure. And, for the end user client, I think that they get an excellent, very transparent execution. And I think that, there was, when I watched the hearings on Capitol Hill, I didn't see very often a differentiation between the asset classes. And there certainly is not an understanding. And I wouldn't expect it from somebody that sits on a House Financial Services Committee. I wouldn't expect the nuance between equity and options to make sense for the same person that's going to walk out of that and go into a Housing and Urban Development Committee meeting or a defense contractor or meeting. It's just, there's too much to know. It's way in the weeds. They've got to trust us. I think what we're going to have to do is make sure that trust hasn't been broken. There's really no reason for the trust to have been broken. I think, as we pointed out in the first portion of the panel, we have been up, we've been running, we've given rational markets for the amount of information that's into that marketplace at that moment on a daily basis. GameStop, I think, was a bit of a sideshow, and hopefully that dies down and people are able to realize that the Phils, our industry, our trading industry, did as good a job as you could expect in the circumstances.
Kevin is an exchange operator that deals with both cash and option markets. How do you distinguish payment for order flow in equities versus an options market?
It's a great question, and it's something we spend a lot of time on. So I've been sleeping, eating, and drinking GameStop volatility since actually later last year. And I'll tell you, from my perspective of sitting where I sit, and I have teams that run a terrific equities program and options program at NASDAQ, the main difference, and Paul touched on this, is actually there are three main differences: exposure, exposure, and exposure. PFOP is different in equities than it is in options, right? We know that we call it a marketing fee, but it's just different because of exposure. You can go out and buy order flow and options, but then somebody who does not pay for order flow might interact with that. And that is what is an exceptional best X experience in options that does not exist in the flawed best X of U.S. equities. And I think that's what we need to do collectively with the equities clients, with legislators, with regulators, is explain to them. And Paul, you hit the nail on the head. It's not from lack of trying. They have a lot on their plate. And those on the panel, are going to take what we say very seriously. And I think we need to focus on best X. Best X in equities is flawed. It can improve. And all you need to do is look at the derivatives industry to see what the difference is. And it's just exceptionally different.
Alicia, because as a clearing firm, you deal across futures, equities, options, OTC markets. How do your clients deal with the complexity of that market structure, and how do they? What does that mean you have to do to help them?
Yeah, no, it's a good question, and I guess I'll key off one of Kevin's last comments as well. When you think across the sort of cleared landscape, our clients, as most of you know, are mainly institutional in nature. There are a couple of kind of core principles that we think about regardless of what the asset class is, right? There's the kind of structure and functioning of the market. There is, the risk management capabilities of our clients. There's the risk management capabilities of us as a clearing firm. And then there's the kind of risk management capabilities of the CCPs. So for us, particularly in times of whether it's stress markets, high volatility, these black swan events, although I'm not sure we can call them that anymore, given the kind of frequency of their occurrence, really the reaction needs to, where we focus and where our clients sort of push us to think about is ensuring that we are partnering from a risk standpoint, that their risk systems, as I said before, are robust, ours are robust, and that we both have a good view on what's actually happening, where the risks are in the system, and are we appropriately navigating those? And I think that is the kind of core principle that goes across whatever cleared asset class that we're talking about. So whether it's futures, options, equities, I think what this does for us is sort of crystallize some of the topics that have been, of recent focus in a variety of different forums, whether it's, membership and appropriate capitalization at clearinghouses. How do we think about risk controls and joining up the risk that we see from an execution perspective to the risk that we see from a clearing perspective? So I think this really joins up a lot of, some of the market structure topics, risk topics, CCP resiliency, and, all of those topics. I think this sort of crystallizes a lot of the work that we've been doing as an industry over the last few years. And I think it puts that into a different perspective, and it'll probably propel some of those topics forward, make them a little bit more mainstream. I think the amount of questions that we answered about what is NSCC, how does it function, what does it mean? I don't think the NSCC has ever been really discussed quite as much by the sort of broader client universe. So it's been a very interesting set of discussions that we've been able to engage with clients on. And I think that'll continue on the forward. And it's good. I think it's the right discussion we should be having. I think it's the appropriate kind of risk management lens that we all need to be thinking about. But I do think those conversations will continue to be a little bit more mainstream, which will be interesting.
No, and it is. And I agree with you. Sorry, Paul. As I was thinking about it, is an operator of a CCP, the best day is when no one knows we're there, right? It's very rarely a good thing for any industry or market participant if we, NSCC or any of the other clearinghouses, are in the forefront of the dialogue. So I'm sorry, Paul, I cut you off.
Yeah, you guys are the offensive linemen of the financial industry. You do all the hard work, get hit in the side of the head all day, but don't necessarily get the glory, only when you get a flag. Though I have to go back to the 605 reporting, or the best acts, and that to me is really where the rubber hits the road. I think in options it's going to be very, very difficult to really nail that down, because as you look at the flow coming out of different houses, they have particularly different ways that they manifest themselves in the marketplace. So if we get the 605 reporting, I think it will, and I think that's probably where the industry is likely headed. I think we're going to have a very difficult time. I think in the equity side, when they went through it, it became very, very difficult. It was a years-long process, and I don't know if it's completely done at that level. But I do think the best X measurements and thoughts about it and dissecting it a bit would be helpful. So I know kind of speaking both sides here, but we need people to trust the process and really do look at the markets and what their fills are, and both equities and options. I mean, I'm not throwing. Just want to make sure I'm not throwing equities under the bus because they don't have competition at the exchange level, but they have competition to get those orders in the first place. So when they get those orders, they do print them at prices that are tough for exchanges to do. So that's a different world. But certainly, the end user's getting the right price or darn close.
Well, and I think it's also hard when you've got 1.5 million products, and it's also hard to get an agreement on, given that population, what best execution is, right? Sometimes it's speed, sometimes it's certainty. Obviously, price always is going to matter, but you got a much more complicated product mix, and so best can sometimes be in the eye of the beholder. Alicia, you mentioned it a little bit, and I want to go back and touch on it. What are you seeing from the buy-side institutions? Because we've heard a lot about the growth of retail and Reddit traders, but what's really happening with the buy-side participants? Is it still active in growing? Is it that they haven't grown as fast as some of the other client segments? What's your perspective on terms of buy-side participation in the options markets?
Yeah, I mean, I think we're still seeing it as certainly an active participant in the overall landscape. I would say, continuing to grow. We are there, and we continue to provide, facilitation to that client base. So, active and growing. I think, the other side to that is we're obviously seeing a majority of the growth, particularly in single stock options, driven by our more retail client base. As I mentioned before, we tend to service more of the institutional side, so we're not a direct servicer to the kind of end retail user. However, when you comb through the data that's out there, our observations will be similar to many, and I'm sure as what was discussed on the retail panel yesterday. The wide kind of majority of the growth in single stock options, particularly short dated options, has really been driven by retail. How does that normalize over the course of the next 12 months, particularly as we get into reopening? There's a couple of different perspectives on that, but I think, we still see quite an active engagement from our institutional client base.
Kevin, as you think about product development in the retail space and then sort of potentially the complexities that adds to our market structure, given we already have 1.5 million products, how do you start thinking about sort of whether it's smaller contract size rather than a round lot, and those types of product development issues and the potential implications for market structure, given, potential for strike proliferation? What's your perspective on how the retailization of products may play out in the options?
So thanks, Scott. I look at it as sort of defense and offense. And I think of defensively, this is where we work together, right? This is things that like Alicia, authorized give up that she brought to us many years ago that we solved. Risk-weighted assets, where Paul was really integral, as many others. And we solved it. The strikes, proliferation of strikes, we're solving it. Obvious error, we're solving it. So defensively, I think that all ties back to resiliency, and we're nothing without that resiliency. I said it ad nauseum. 2007 and 2009, we were extremely resilient. These last year and a half, Alicia pointed this out as well, extremely resilient. And then now think of the offensive side. And I think that's where having 5 exchange families, 16 exchanges, where can we innovate? And that's where you're starting to see, things. I won't even tout our new products. People know who our new products are. But firms, exchange operators coming out with innovative new products. And just that's where we can focus on intelligently having weeklies. Because again, weeklies are a very innovative product that works. And who are we competing with? We're competing with crypto. We're competing with sports gambling. We need individually to remain innovative if you want to keep that GameStop, that Reddit crowd. And I think Chris Larkin said something really important yesterday, which is like these investors, they're smart. They're not like, forget the old like retail is dumb. These are not dumb investors. These are great investors. These are smart investors. They have their niche. We need to help them and educate them. But there's so much there. And I think the short answer to your question, Scott, is each individual exchange family should try to innovate on their own. And that's the beauty of the competition within options. But resiliency is we cannot take that for granted. We never have, and we never will.
And Paul, I know you have a perspective on being a routing firm and working more closely with the retail firms. What are you hearing and seeing from them in terms of their product development needs, and what do you think it means for our market structure?
Well, I'll start with the market structure aspect of that question. It's a little frightening, and since I've been on the forefront of working with Greg Ferrari at NASDAQ, trying to get the strike number down to a rational, usable number. But it doesn't mean we want to get rid of them just to get rid of them. There are ways to get the right strikes up for even smaller products. It certainly throws a wrench in a bunch of the costs that are associated with each trade, an OCC fee or something like that goes with a trade. What happens when the trade is significantly smaller, a tenth the size or a hundredth the size? Those are the aspects of it that become a little thorny. And as competitors, we'll figure out what the right price is and the way to do it. If we can get past that, I think we can provide liquidity. I don't think that they need. I don't think a mini would need more strikes. And I will give the disclaimer: I was a huge believer in minis 7-8 years ago when I was at TD Ameritrade. I was like, customers are going to love this. And that was probably as far off as it possibly could be. So now that they're coming back around, part of the issue is that the products are, Amazon's $3,500 a share. Now you understand that the mini is actually just a regular, just notionally. But we need to evolve and get our products into the right hands. And I agree with Kevin. We're in competition with non-traditional other assets, meaning gambling. But it doesn't mean we're gambling. And the best thing about this, and I've been very excited about it since the beginning of pandemic, is we're getting all these new traders. And Robinhood, love them or hate them. And they're the poster child for this. They've got a bunch of people that never thought about investing in this way. What it seems like, swallowed the education, used it hopefully in the best way they can. Of course, there's going to be people that use it poorly, as in everything. But you now have a class of investor that is brand new to this and starts to take hold of the American dream of creating wealth. And those are all the things that I think are real positive. So if we can get someplace where we can provide this for them, that's great. If it's minis, fantastic. Again, Kevin's right. Competition amongst the exchange families and with the resources they have for making these things work, let's see it happen.
Good. Kevin?
I will note, Scott. Sorry, I was just going to say, I will note, if you think of and kind of compare panels that we've talked about from a market structure standpoint over the course of the last few years, this is actually a really nice change in tone, right? Where the last few years was very much focused on more risk issues, capital issues, some of the kind of negative effects that's had on the options industry at large. So it's nice to kind of think about and talk about innovation and growth and how are we responding as an industry. As an industry, it's just kind of strikes me as very much a refreshing change in tone from the last few years.
No, and thank Alicia, you for that perspective, Alicia, because I think the fact that we were as resilient, and now you can look at what do we do to broaden participation in option market, is a great opportunity for the industry. I'm sorry, Kevin.
I was just going to add actually one other thing about Paul with gambling. You know, what's funny about the way I look at when I say we compete with crypto and gambling, I just want to be clear. Like, people generally take a percentage of their assets, whether you're 23 years old or 43 years old or 63 years old, and say, like, I'll have some risk there. And what I love that we seem to be doing is converting, and we did this all throughout last year, converting some of those folks who would potentially be just risking their capital at the casinos or somewhere else, and they're turning into investors. And I think that's key. Like, they're starting to do research, and they're saying, wow, I can own Chewy.com, and we're just like a sponge for them. Like, we're giving them knowledge and education. They're learning through experience. And I think we're converting people over to the markets that are the best in the world, the most transparent in the world. And I love the fact that we are attracting investors into the option space. I just want to make that clear. I think that's really important.
No, and I think, but that's actually sort of the question is, what's the unintended consequence of some of the House Financial Services Committee hearings? And do you think that there's the right focus on market structure, and what's the risk coming out of that? Because I don't think any of us are going to sit in any room and say suitability isn't a key issue. Investor education isn't critically important. I don't think any of us participate with OIC and work with Julie and Denise and the team there because we don't think education is critically important. But, you know, some of the tone of the hearing is decidedly different. And so, Kevin, what do you think is the unintended consequences potentially of those hearings?
The unintended consequences is that we restrict people from coming in like we did many years ago through other crises. And I would point to this. February 18th, the panel, a lot of good information coming out of there, from Ken Griffin's comments to legislators' comments and their questions. And I thought it was an exceptional panel. For folks that have a lot on their plate, I thought it was really thoughtful, intelligent. But there was one statement that just stood out to me as really, really important. So Jennifer Schultz, whom I don't know, Director of Financial Regulation Studies at Cato Institute, said something really important. She said, by no means should we restrict retail access to the markets. And I think that is key. Like that we're democratizing markets. Let's not go the other way. And then for those that, they're nameless at this point, but for those who will want to overregulate, potentially something we need to stay ahead of, we need to educate. We need to spend time on the Hill. We need to spend time, at conferences like this. We need to have the dialogue, Scott, with you, with other SROs, with SIFMA, with FINRA, and just boom, 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 STA, and keep that narrative out there. These are the most transparent markets in the world. We're attracting investors. We need to do better. We certainly can do better, but let's not add too many restrictions. I'm really worried about that. That meaning, let's just stay ahead of it and we'll be fine.
Good, thank you. And Alicia touched on this a little bit. We continue and we have the past topics, whether it's strike proliferation, give ups, give in, risk. What are the other issues that you think from a market structure perspective we have to continue to focus on and further the work that the industry's been doing? And where are we on those? Alicia, I know give up and give in risk to the bank owned clearing firms is a particular issue because of the Fed. We've made progress. Where are we in sort of or getting to the end state?
Yeah, I think we've made great progress on the give up and give in risk. Thank you for all the help from everyone on this panel. I know you were all right there with us in trying to push some of these initiatives forward. I do think there is more to do in sort of the general functioning of CMTAs and how they move around the system. And generally speaking, kind of thinking about how do we define the amount of risk that we should be clearing, and how does that tie back to kind of execution and thinking about really joining those two up, probably in a different way than we've historically done. I don't think that's an easy problem to solve, and I think that will kind of happen in stages as well. But I do think that's something important, particularly as the participation in the markets changes, and it is driven in large part by retail, in addition to the kind of more traditional participants that we've seen. Kind of all of the topics that you've talked on. How do we think about education? How do we think about pushing that education out, and how is that consumed by, in particular, the retail universe? Is it through smartphones? Is it through, so how do we think about all those things, but really making sure that we have an appropriate lens on the risk and furthering the good work that we've already done. But so I think that starts with CMTA, but I also think that kind of really starts to kind of hit at how do we join up execution and clearing risk? Because I think a lot of what we solve for is clearing risk, and rightly so. But I think we have to kind of think about those more on a conjoined basis.
Well, and I know we've talked a lot about retail, but isn't it also fair to say that the sort of this, and we talked about it's never a good day if anybody's talking about a CCP, but isn't it true with your buy side participants that's actually become an increased area of focus in question as they've moved from OTC markets and bilateral markets into centrally cleared? They have a lot more questions about market structure, resiliency, to help those buy-side participants understand U.S. option market structure and the resiliency and stability of it.
Yeah, that's right. And I think if, again, we kind of look at the landscape of cleared products, right, and you think of the sort of newest entrant to the system, right, swaps clearing, and you think about the market structure there and what we're able to do through industry utilities where we can define limits. It's very much done on, a credit basis. And that really defines the amount of risk that clients can put on from an execution standpoint. How do you take some of those principles and overlay them into kind of very evolved and very mature markets, whether it's equities, whether it's options? So that will continue. I think that's still an education topic in the listed options industry. I think it's becoming more of a discussion in the equities industry. And I know Kevin and Paul, you've both been really helpful in some of the topics we've raised on the equity side as well to try and further the kind of dialogue from a risk perspective. But Scott, I don't think that's going away. And I think investors will look to continue to be more educated on what are the actual risks in the system, aside from just the market risk of what they're trading, but what is the risk in the system, and how does what are the kind of trade flows, what are the money flows, and where in the life cycle of a trade, and where in the life cycle from a clearing perspective do they continue to have risk, again, outside of just the economic risk on the position that they're holding. So that will continue to be a part of the education. And I think it is probably something that we have to do a better job of as an industry, and using the trade forums, Kevin, that you just referenced, kind of to distill that down and be able to kind of help investors consume that information as well.
Thank you. And Paul, as a routing and liquidity providing firm, what do you think are the challenges that are at the top of the list for the industry to deal with?
So the two easy ones are ones that the committees have been dealing with, which is the obvious errors and strikes. And both seem to be, as we harmonize obvious errors, dealing with obvious errors and make them fewer and fewer. And I think they are becoming fewer and fewer each, week, month, year. That is a nice progression we've done. Strikes, we're on the right path with Greg and Kevin leading the way. It's been a fantastic move. What I'm really concerned about is really a cost and because of technology and on top of it, cap is going to make it so that only the biggest of big have a chance to compete. And I'm worried that there's no new market makers walking in the crowd to bring us back to most of our starting dates. Other asset classes to jump into our, very active marketplace. That's fantastic. But as you lay over cost, really CAT is the one at the top of my list these days, since we've just saw what the costs were going to be. And you feel like it's death by 1,000 cuts. I'm afraid that regulation is, because of GameStop, is going to create a bunch of exams that we all can see from our best execution reports that we give directly to the order flow providers. It's all there. It's discoverable. It's easy. We know what we're doing. Those things all make sense. But as you have to take your eye off of the liquidity provision and put it into something that's not directly impactful for that liquidity provision, because it just like any backup plan, it's really something you have to work on.
No, and it gets increasingly challenging. And you talked about it earlier. Is I think we all, whether you started on a floor or have joined in the electronic, it's about trust, right? And I think transparency is probably the best way to build trust. And so it's helping people understand how things work. Because when we were listening to the GameStop hearings and we talked about securities lending, that wasn't really in the forethought of what I thought was the issue. But when you hear that somebody's short more than 100% of the float, that strikes me as odd. And I thought we had affirmative locate requirements. But then you realize that there's market participants who borrow to lend. And so you got relenders. And so it's helping people understand how the market structure works and where the real problems are, because it's not always clear that we have a clear problem statement of what we're trying to solve for, right? And so I think the more we can do both with market participants, but also the legislative community, to provide a lot more transparency about how does it work and what are the potential solutions, I think is something we've all been spending a lot of time on, and is an industry are going to continue to have to work on. As we come to starting the end of our time, what keeps you up at night? And what does the new normal look like? Is this the way it's going to be, Alicia?
I hope not. I hope to never have to homeschool my children again. I joked about a year ago. I've been at the firm over 20 years, and I probably a year or two into my career, I had thought about leaving the firm and becoming a third grade teacher. Obviously, I didn't. 20 years later, I'm still sitting here, and that was the road best not taken, as I've learned. So hopefully, in that regard, we're not still sitting here. I mean, look, there are a lot of things that keep us up at night. A lot of it is really in the risk lens, but I would balance that with, with the amount of innovation, with how our markets are evolving at a pace where, in many instances, when you think of some of the infrastructure that's the backbone of the industry, how do we ensure that we have the capacity, we have the resiliency in the system, we have the right risk management, across the ecosystem to be able to appropriately facilitate that innovation. So I would say it's, always risk, and that will always be the kind of primary thing that creates, caution and focus and the appropriate amount of concern. But I would say that's kind of in part balanced by the pace of change has changed dramatically and has really accelerated, which is exciting. But ensuring that we can keep up with that pace of play, both in our kind of individual remits, but also as an industry, I think is becoming an increasingly concerning factor. And that's, across all of those facets that I just mentioned.
Good. Thank you. Kevin, what do you see on the horizon? What's new normal look like for NASDAQ?
Yeah, I mean, again, I'm going with innovation because I think it's an opportunity for us to develop our own products, to grow out our volatility space, things like that, our NASDAQ 100 ecosystem. So we really look at it two separate ways. One is, our responsibility as stewards for the industry and our leadership position there, but then also our own innovation. And I feel really good about NASDAQ's innovation there. And you didn't specifically ask me, Scott, what keeps me up at night, but I'm going to steal Paul's thunder because he and I are aligned on this. I do worry about cost, just added cost. CAT's one of them, and I would encourage people to comment on the recent CBOE and NASDAQ filings on CAT. It's an important forum for comments to be received by the SEC. So I think it's important that we do that. And because we don't know what's going to come out of GameStop, that keeps me up at night. We do so much so well. We take care of our own resiliency, but what we can't handle are these restrictions I referred to earlier, potentially, maybe tax policy. But I think we all need to be out there on the Hill, all those places that I mentioned earlier, and we'll be fine. I mean, we have an unbelievable core of great stewards in the options industry. I'm just honored to be part of it.
Okay, Paul, same question for you, and then we've got a question or two. Okay,
the phone ringing during my panel, that was one of them that just happened. The other is, keeps me up at night. I really echo what Kevin said. We really fight hard to do what we do. The margins are razor thin. As new regulations and costs get tossed onto the industry, it squeezes our ability to make liquidity that tight. It also, and CAT's a perfect example. It's difficult to deal with, knowing that as our engineers would say, we could have done it cheaper and better. And I'm sure that, a lot of other places feel like the same way. We'll see. That certainly keeps me up at night. I think our story is fantastic as an industry. So really I'm parroting everything Kevin said.
And I think the industry did a phenomenal job in building trust and confidence. If I can, sorry, Paul, go ahead.
No, I was just going to say, and the new normal is going to look like what everybody probably thinks. We are going to have more people working from home. It's going to be more acceptable. It's going to be, our traders are probably going to be back in the office, and we got to stay hungry though. Other asset classes can go into our space. We're seeing it. Futures are touching, portions of us with their minis and those ideas, and crypto. Those sorts of industries have a good chance of jumping in on us. So got to keep that innovation going, because they're not. They're not going to stop.
Okay, to go to the one question that came in, and Kevin, I know you've got and Paul, a really good perspective on this, is in options, given that you're not directing order flow to a venue, what's the purpose of payment for order flow? Is it more of a marketing fee? How do you think about the purpose difference for payment and order flow for options versus equity?
I'll jump in first, only because I think Paul's going to give a more thoughtful answer. I look at it as, because we have exposure and because BestX is so good and investors are getting the absolute flawed, equities can do better. But options, you get without a doubt the best price on your execution because of the exposure. So for that, we have those wholesalers that go out and buy order flow, and then somebody who does not do that gets to participate. So that's why it really is a marketing fee. They're marketing the options industry. They're saying, we will give you the best price, and anybody can interact with it. It's completely different than in equities. But I promised I would let Paul give a better answer.
Oh, no, you hit it on the head. It is, it's a guarantee. You want to have someone writing your orders that's going to guarantee in quotes the best execution you're going to get for this order, and take control of it on your behalf and do what's best for it. That is a job that you will take on and take seriously and compete for. And I think the marketing fee makes that a little more transparent to how it's getting done.
Well, and Paul, if you can, because you talked about cost, but if you can just share some perspective on what order routing firms have to invest in to make sure that best execution occurs.
Well, I mean, it is the amount of checks on all the marketplaces and all the risk associated with each one. I'm going to miss dozens because there are dozens of checks and thoughts that go into this. And checking the markets, finding the best place to find the best liquidity for that individual order from that individual firm, reporting it back in the way that they want, and putting it in the buckets that they analyze. All there's we could have a 45-minute panel on just what makes it work. And if you think about it this way, like one of the outcrops of potentially of a GameStop is if you get rid of payment for order flow, how do these orders from the retail firms get out to the marketplace? If they employ their own market maker, that's one market maker instead of having 5 or 6 compete for your order flow. It's one router, trying to take this order to the best place for execution. We're all competing for that right every day. That is why the customer does so well.
Well, and thank you for that perspective. And it's hard when we all work in an industry that tend to be judged by the quality of our last fill. So it is really important. As we come to the end of our time, I just want to again express my appreciation to Alicia, Paul, and Kevin. I really thank you for your time today. I also want to thank my colleagues from OIC from organizing this event. Thank you, Kevin, for acknowledging it. I think trying to do an industry conference like this in a virtual environment is tough for everybody. But I think the fact that the whole industry with the sponsors is willing to work together to provide this content in education kind of is the perfect summary for what's important in the market structure is continue to invest in education and resiliency. So I just want to thank you all again for your time today, and look forward to continuing to see the U.S. options industry thrive, hopefully under a little bit better circumstances, because I agree, Alicia, I don't think that I want to get intimately involved in course prep for college preparation for my daughter ever again the way we did this year. So thank you, everyone.
All right. Thanks, Scott. Thank you.
Thank you, Scott. Great discussion. And we now invite you to click into the Thursday keynote presentation on the agenda page. Our next session will begin shortly.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.